Hello, my name is Chris Martin. I'm the director of Beyond Profit. The purpose of this video is to try and explain to you one of those areas that confuses many clients, or perhaps not confuses, but we don't explain it very well to them or to you, which is why when you're the owner of a limited company, also the director, we encourage you to structure your remuneration, to structure your income from the company in the form of a very small salary and a much larger dividend. So let's just see what this is about. The key point here is that you have two very different relationships with your company. On the one hand, you're a shareholder. You own the company. It may be entirely you, or you may own part of it and fellow shareholders own the rest. But the point is, you are an owner of that company. You also have an entirely different relationship, which is you're a director of the company. Effectively, you're a glorified employee. You manage the company on behalf of the shareholders. It sounds rather strange because you're the same person, but of course in very big companies, in listed companies, like for example BT or Barclays Bank, the shareholders and directors are different people. The shareholders are mostly institutional investors like pension funds and insurance companies. The directors are appointed, separate people, appointed to manage the company on behalf of those owners. In your case, if you're the owner of a limited company, you're both of these things, aren't you? You are an owner and you're a manager, hence the acronym OMB, or Owner Managed Business, also SME, small, medium-sized enterprise, same sort of thing. Basically, you occupy both roles, which brings with it planning opportunities when it comes to tax and national insurance. The reason is, income received as a shareholder is treated differently to income received as a director. As a shareholder, your income is called a dividend, as you know. If you own shares in BT or Barclays or one of the other big listed companies, if you're lucky, twice a year or perhaps every quarter, you'll receive a cheque from them. That's your share of the dividend for that period of time that's been declared by the directors. As a director, you're an employee. You receive a salary, just like any other employee. The good news is, because you own the company, and you're also director of the company, you have complete control over it. You can decide whether your income is a dividend, or whether your income is a salary, or whether your income is a mixture of the two. Why would you want to do that? Because different tax and national insurance rules apply to the different sorts of income. So dividends and salaries are treated differently. And whenever you've got, in this case, a single sum of money, £1,000 taken out of the company, and you can call it a dividend, or you can call it a salary, or you can call it something different, and different rules apply depending on what you call it, then opportunities for saving tax and national insurance arise. In fact, we talk about tax mitigation and tax saving in this area, but it's actually largely, or all actually, a national insurance saving issue, not a tax issue. The tax situation is pretty much the same whether you take your money as a dividend or as a salary. It does change when you become much bigger, and much bigger dividends are being paid out. For the vast majority of us, it's fairly neutral at the moment. Salary attracts two types of national insurance. Employees' national insurance at rates up to 12% is deducted before the employee receives the money, and the employer's national insurance at a rate of 13.8% is essentially a tax on employing people, and the company pays that over. So every £100 gross salary it pays to an employee, it has to pay 13.8% national insurance, or up to 13.8% national insurance over to the government. So it's a very expensive business. Dividends, on the other hand, are unearned income. They're investment income. They've got nothing to do with earnings. Therefore, they don't attract national insurance. So there's an obvious wheeze here. If we can minimise the amount of salary we pay and maximise the amount of dividends we pay, given that the tax situation is pretty much neutral, clearly we're going to save national insurance. Now, it's very difficult to do analyses like this without bringing numbers into it, and unfortunately I have created a spreadsheet, so bear with me, it's not complicated at all. All I've done here is said, look, here's a scenario. You have a company that has a profit of £50,000. what are you going to end up paying to revenue customs, the government, under various different extraction regimes, in other words, dividend and salary mixes? Well, let's imagine in the first column you're taking it all out as salary. So you've got £50,000, you can take that out. Well, bear in mind, for every £100 you pay yourself, you've got to pay 13.8%, or rates up to 13.8% to the government. That £50,000 won't all go to you, some of it has to go to the government. So it just so happens in this case, that's how it splits down. 44,800 will be the salary and 5,100 will be the employer's national insurance. There's no profit left over, so there's no corporation tax, the company hasn't got any tax to pay. There's no dividends, there's no profit, there's no dividends, so there's no dividend tax to pay. Therefore, you simply have PAY on your salary. PAY, pay as you earn, is just the way of collecting income tax on salary. Okay, so you have income tax on your salary, 7.8, so employees' national insurance on the salary of 4.4, and employers' NI, as we worked out above, of £5,000. So the total tax and NIC cost, NIC national insurance contributions, the total tax and NIC cost is just under £17,500 at current rates. So that's a 34.9% cost. It's 34.9% of the 50,000. Okay, which may sound okay until you compare it with what you could do by restricting salary. Now, these next two, well, in all of these columns, bear in mind that we are treating you and your company as a global entity. You're not, you're two separate entities. But for tax purposes, if the company's paying corporation tax, at the end of the day, if you're the owner of the company, that's sort of coming out of your pocket. So we treat it as a global thing. So the corporation tax and the income tax, the national insurance are all lumped together for the purposes of analysis. So in this second column, let's imagine we reduce your salary from 50, or your salary plus the employer's NI, from 50 down to 20. What does that do? Well, it leaves us with a bit of profit there. We've got some employer's national insurance, it's a bit lower because the salary is low. We've got a bit of profit there. We've got some corporation tax at 20%. Let's assume it's 20% to pay out. That gives you a potential dividend of 24,000, which we then pay out as a dividend. You are just about tipped into the higher rate tax band as an individual when you add together your salary and the dividend. Therefore, there's a bit of dividend tax to pay there, a bit of higher rate tax on the dividend. You've got some income tax, and you've got some employees and employers' NI as well. But it's a much lower figure overall because, as you can see, the national insurance is so much lower, isn't it? The overall tax is pretty much the same, but the national insurance is lower. £11,500, that's a 23% effective tax rate, an effective cost of taking that £50,000 out. In the last column, we've done exactly the same thing. This time we've reduced the salary down to £10,000, something not entirely different to the minimum wage. So exactly the same analysis applies, and we get the overall cost down to about £9,500 or 19%, much lower than 34.9%. And as you can see at the reconciliation lines at the bottom there, just to see where the overall figure's coming from when you add it all together, the tax isn't massively different. It does go up slightly, in fact, but it's relatively immaterial, isn't it? This goes up from 7.8 to 8.9. NIC, on the other hand, falls from £9,600 to £557 for exactly the same amount of money coming out. So it's a massive national insurance saving, and that's why we want to reduce the salary. It's as simple as that. Now, you might think, okay, so if we're reducing the salary down, we're paying much less national insurance, which helps us. Why not reduce it to nothing? Why not pay no salary at all? Well, don't forget that employees' national insurance, not employers, that has no impact whatsoever on this, but employees' national insurance forms the basis of your contribution record for certain state benefits, such as the state pension or job seekers allowance. If you don't keep that contribution record up to date, you will receive nothing, or certainly less, of certain benefits if you ever need them or when you come to require them. So ideally, you will keep your contribution record going. So you might say, well, we want to pay some national insurance. Okay, well, not necessarily. You've got to earn a certain amount of money to be in the NI system at all. Okay, but once you've reached that threshold, you can actually earn a couple of £1,000s more and still not pay anything, but have your contribution record maintained as if you were paying something. Okay, so this is to encourage people to enter low-paid work without losing benefits. So essentially the government is saying, look, we know you're not paid much, but we will make up your contribution record so that you're not being adversely affected by taking a job as opposed to not taking a job. So, we can take advantage of that. Now, the optimum salary you want to pay yourself, therefore, is the maximum payable whilst paying no national insurance but preserving your contribution record. So in other words, you've got to get over the threshold of actually being in the system, but there is still some more you can pay yourself as a salary and have your contribution record maintained but still not pay any national insurance. And it just so happens in the current year, 2012, 2013, this happens to be a salary of £7,488. If you pay yourself £7,488, you will pay absolutely no employees or employers' national insurance, but your contribution record will be maintained as if you have done. Okay, so you'll be absolutely no worse off. You will be in exactly the same position, in fact, if you paid the relevant national insurance on £500,000 or £1 million or £2 million. No difference whatsoever. I've just done a little spreadsheet here showing the impact of that. Well, you can see here, you just have to trust my maths is correct, but here you've paid yourself £7,488. You can see there is, of course, a corporation tax charge because you have profit. You take the rest out as dividends. But you can see there is no employees' national insurance, there is no employers' national insurance, but your record will be maintained. Your overall tax cost and tax national insurance cost is £9,000 or 18.26%. That's the optimum position for this particular company. Note the note, which is that if you paid yourself a salary of £7,489, £1 more, you would start paying employers' national insurance and it would be 14p. So this is the point at which you start paying national insurance. Note that employers' national insurance is paid at a slightly earlier or slightly lower threshold than employees' national insurance, but of course, so you could pay yourself a slightly higher salary than this and still not pay any employees' national insurance and still have your record maintained, but you would be paying employers' national insurance. So we don't do it. We say this is the optimum position. Hopefully that makes sense. So just to recap, if you pay yourself a salary at the moment of 7,488, you will pay absolutely no national insurance whatsoever, but you will have your contribution record maintained. You'll be in exactly the same position as if you paid national insurance on a much higher salary. You want to maintain your contribution record because it does give you entitlement to state benefits, things like job seekers allowance and, of course, a state pension when you're older. As I said earlier, it's just how it works. It's a perfectly legitimate national insurance avoidance method. It's almost lesson one in tax and national insurance planning for owner-managed companies. And if you're not doing it, you're missing a trick, basically. As to the future with this, it depends what the government think. There's often in our world of accountancy and tax, there is often discussion about or speculation as to whether the government of the day will jump in with both feet and charge national insurance on dividends, which of course would make this planning completely defunct. They haven't done it, so we'll have to see how it goes. But while it's there, it's best to use it, I think. Hopefully that explains things a bit for you. If you have any questions or need anything clarified, please don't hesitate to give us a call, and thanks for watching. Cheers. Bye.